Silver investors. Markets just opened the week by slamming silver 3.5% lower in a ghost market where America is on holiday. China is shut, and algorithms are free to push the price around with almost no real buyers in the room. The headlines blame a stronger dollar and no March rate cut. But if you zoom out and look at liquidity, Fed math, and the physical market, this 3.5% candle says more about structure than about silver suddenly losing value. I'm OG John AG. And in this video, I'm going to break down why silver dropped from 78 to the mid-74s as the week opened, what this move has to do with U.S. jobs data and the Fed's next meeting, why it happened on the exact day both U.S. and Chinese markets are closed, and how to tell the difference between a real bearish signal and a Monday morning shakeout in a thin, holiday hit market. Segment 1. The 3.5% dump. What actually happened on the screen? Let's start with the basic facts, no drama. According to economies.com, as the new week opened, silver futures fell about 3.52% intraday, dropping from around $78.19 to near $74.67. This move came as the week opens up, meaning right out of the gate, not after some huge new headline. On the same tape, the U.S. dollar index was firm, supported by recent strong U.S. economic data. Traders were reassessing how many rate cuts the Fed can actually deliver this year. Economies.com frames it like this. Silver is under pressure because the dollar is strong and markets see a lower chance of near-term Fed easing. Support area, $74.15. Resistance area, $78.65. So if you only look at the chart and that one explanation, you get a simple story. Dollar up, silver down, nothing to see here. But that's not the full picture. The real question is why this move happened today in this specific liquidity environment. Segment 2, the calendar trap, US and China, both offline. Now zoom in on the calendar because this is where it gets interesting. This 3.5% silver slide happened on a day when the United States is observing President's Day with cash markets closed. China is still shut for the Lunar New Year holiday, with Shanghai's main exchanges offline. That means two of the biggest players in global capital markets, US and China, are effectively absent from the spot and futures order book. Economies.com notes that the session is pressured by a strong dollar and affected by markets assessing U.S. data, but they also point out the holiday context. What they don't spell out is the structural effect. With Wall Street desks half-staffed or fully closed, and Shanghai totally dark, order books are thin. A few medium-sized sell orders can move price as if a whale just dumped their entire position. This is classic ghost market behavior, big players mostly absent. Algorithms and a handful of traders dominate flows. Moves that would be 1% in normal liquidity show up as 3 to 4% moves. So yes, silver is reacting to macro data, but it's doing it on a day when the market is easiest to push. Segment 3, the macro setup, strong jobs, sticky Fed, and the no March cut story. Now let's talk about the macro excuse the market used to justify the move. Economies.com highlights recent U.S. jobs data and economic indicators have surprised to the upside. That pushed traders to sharply reduce the probability of a rate cut at the Fed's March meeting. According to their note, the market now sees roughly a 10% chance of a March rate cut. In other words, a 90% chance of no cut. When rate cut expectations drop, the dollar tends to strengthen because U.S. assets look relatively more attractive. Yields on U.S. treasuries stay higher for longer. For silver, this creates short-term headwinds. Silver doesn't pay interest. A stronger dollar makes commodities priced in dollars look more expensive to foreign buyers. Economies.com explicitly links the move to concerns about the path of U.S. interest rates. In other words, this 3.5% drop is the market repricing from maybe cuts soon to maybe cuts later. That's the trader narrative. But again, changing odds on a 25 basis point cut in March doesn't change the structural silver story. It just changes how impatient traders feel this week. Segment 4. Technicals. $74.15 support and $78.65 resistance. Economies.com gives a clear technical map for this week. Current price area, around $74.75 after the slide. Support, $74.15. Key level, a daily close below. This opens the door to deeper downside. Resistance, $78.65. A reclaim of this level would signal the market is shaking off this Monday dump. They also flag the bias is bearish in the very short term, as long as price stays below that $78.65 resistance. This is critical for your strategy. If silver stays pinned under 78 to 79s and breaks $74 with conviction, the market is telling you, we are still in corrective mode. Don't pretend the bottom is confirmed. If silver bounces quickly back above $78.65 and holds it on a closing basis, that says, this 3.5% was mostly a holiday shakeout. Buyers are still there. For content, you can literally put this on screen as a simple framework. Below 74.15, caution, more pain possible. Above 78.65, short-term damage healed, bull argument alive and kicking. Segment 5, why this move is more about structure than about silver. Now, OG John style, let's strip away the excuses and talk structure. What didn't change today? The mining supply of silver did not suddenly jump 3.5% in a few hours. The industrial demand for silver, solar, EVs, electronics, didn't suddenly collapse on a Monday. China's silver export restrictions, introduced January 1st, did not disappear overnight. Shanghai stockpiles that have been drained for years are still at multi-year lows. What did change? A Fed meeting is getting closer. Jobs data came in strong. Odds of a March cut went down. Markets used a thin liquidity holiday session to adjust expectations. So you have two ways to interpret the 3.5%. Silver is broken, sell everything. Traders are front-running a Fed narrative in the easiest environment to move price. Economies.com is basically telling you this is a macro sentiment adjustment, not a new discovery about silver's physical fundamentals. That is a big distinction. Segment 6, how to read this move if you're a short-term trader. If you're trading silver on short time frames, here's how to think about this. From Economies.com's analysis, the dollar strength plus no March cut combo is your immediate headwind. The intraday slide to 74.67 is your big clue. Sellers were active the moment the week opened. Your tactical checklist, watch the dollar index, DXY. If DXY keeps grinding higher this week, silver will struggle to reclaim $78 to $70. Respect the $74.15 support. A decisive break and close below that level opens space toward deeper supports, which you can map from your own chart, e.g. prior lows. Treat bounces under $78.65 as suspect. As long as price spikes get sold below that resistance, the market is still in sell the rally mode. Remember the liquidity context. Don't oversize trades on a week where US and China are semi-offline. Moves can overshoot both ways. Economies.com's tone is clear. Short-term bias, bearish, but grounded in Fed expectations, not in some permanent damage to silver as an asset. Segment 7. How to read this move if you're a long-term silver investor. If you think in years, not days, this 3.5% is almost boring. Ask yourself, did the structural deficit vanish? No. Did China reopen the export floodgates? No. Did central banks stop debasing currencies and running deficits? No. What did happen is silver got cheaper in dollar terms because the market briefly decided the Fed might delay cuts. For a long-term stacker, that's not a get-out signal. That's either a do-nothing signal or a small add signal, if it fits your plan. You can frame it to your audience like this. Traders woke up to no March cut and dumped 3.5% into a thin Monday. But the big picture, energy transition, deficits, de-dollarization, Chinese policies, stayed the same. The only thing that changed is how impatient speculators feel about the timing of the next rate cut. Economies.com gives you the perfect line to close on. Silver slides as the week opens, pressured by a strong dollar and interest rate expectations. Expectations change weekly. Structural fundamentals don't. Segment 8, what I'm watching next, and what you should too. To wrap it up for the next few days, here's the watch list this article points to. Fed messaging and data. Any new comments, speeches, or data that move rate cut odds for May-June, not just March. Dollar index and yields. If the dollar cools off later this week, today's 3.5% can flip into a sharp relief bounce. Price reaction around $74.15 and $78.65. These are your map points, pure and simple. Global liquidity coming back. Once U.S. cash markets are fully open and China eventually returns from holiday, the market will react in a deeper order book. Then you'll see whether this Monday move was a real trend change or just a holiday wobble. Right now, the tape is saying, short-term traders are scared of a stronger dollar and a stubborn Fed. The physical world is still saying, we still need silver to build the future. The calendar on the Fed's first 25 basis point cut doesn't change that. You've been watching John AG here, and I'm OG John AG. If this helped you see today's 3.5% silver slide as a macro sentiment wobble in a ghost market, not a verdict on silver's long-term value, hit like so this kind of context doesn't get buried, and subscribe with all notifications on. Because in weeks like this, the difference between a shakeout and a real trend change is the difference between panicking with traders and thinking like an owner.